Good morning and welcome to today's class. This is financial management. Financial management. So I want to finalize on the topic valuation of securities. This is financial management or the FDM, FYF and IFI. We now continue on valuation models of valuation of securities. Valuation of securities. Now we were talking about the valuation of ordinary shares and we were talking of the methods of valuing ordinary shares. The methods of valuing ordinary shares. So we did on what we call the dividend yield. So today I want to do on the net asset value method. Net asset value method. Net asset value method, that is the second one. The net asset value method. The net asset value method. Say this is a method of valuation. This is a method of valuation which uses the net assets, to determine the value of the company. So value of the company will be given by the fixed asset plus the current assets plus any amount of goodwill minus the liabilities, you minus the non-current liabilities. Then you also minus the preference shares, and then you divide by the number of ordinary shares. Number of ordinary shares. If this is a fixed assets. Here this is the current assets. CL is the current liabilities. NCL, this is the non-current liabilities. Current liabilities. Or we can also get this by taking the equity plus the reserve or I just say ordinary share capital plus reserves, then you divide by the number of ordinary shares. Do financial management paper. We do from financial management paper. do from the financial management paper. Financial management paper. December 2022, question 2. December 2022. Financial management is December 2022. Question 2. Hey. December 2022. Do question 2. December 2022, question 2. DOPCO Limited has the following summary of statement of financial position for the year ended 30th September 2022. We've been given there the non-current assets, where we have the freehold land and building. We also have what we call the plant and machinery, and we also have the equipment. We have what we call the goodwill. Current assets, we have inventory, trade receivable, and we have the short-term investments. We also have the cash. We've been given the current liabilities, where we have what we call the trade payables, taxation, and we have the preference dividends. Given the equity and liabilities there, you also have the long-term 12% long-term bonds. We have the deferred taxation, ordinary shares reserve, and we have the 6% preference shares. They want the value of each ordinary share using the net asset value basis of what? Valuation. So using the net asset value basis of valuation, it will be given by the fixed assets, which is 520. You add the goodwill, which is 40,000. You also add the current assets, which is 320, less the current liabilities. Current liabilities are a total of 200,000. 200,000. Non-current liability 140. That is both the long-term debts and also the deferred taxation. And then we less the preference shares of 100,000. 100,000. Then I should divide by the number of shares. So number of shares here, you just go to the ordinary share capital. We were given there the ordinary share capital was of how much? It was of 160 what? 160,000. You will divide by the value 10. This will be 16,000. So here you divide by 16,000. What will be the value per share? What will be our value per share? What will be our value per share? What will be the value per share? Getting how much? 27.5. We've also said you can also get the value per share by taking the ordinary share capital, which is 160. You add the reserves of 280, and you also divide by the number of shares, which is how much? 16,000. So it should also give you 27 point. Should also give you the 27.5. That is on what we call the net asset value method. And now the James Walter model. James Walter's model. James Walter's model. Talk about the James Walter's model. James Walter's model. The James Walter's model. James Walter's model, you say this is a method of valuation. The method of valuation which states that a company's dividend policy company's dividend policy affects the value of the company. Affects the value of the company. See, it is based on the following assumptions. It is based on the following assumptions. It is based on the following assumptions. Number one is that the company will exist to infinity. Company will exist to infinity. That is, the company is a going concern. Company will exist to infinity. That is, the company is a going concern. That is, the company is a going concern. Number two, the company is all equity financed. Company is all equity financed. Company is all equity financed. What we mean is that the company is only financed by the equity, the ordinary shares and reserves. When we talk of equity, we are talking of ordinary shares and reserves. Number three, company uses retained earnings to finance investments. Company uses retained earnings to finance investments. Company uses retained earnings to finance investments. And then the last one is that the return on investment remains constant. The return on investment remains constant. Return on investment remains constant. Return on investment remains constant. Now, to get the intrinsic value to be given by D plus the earning per share minus D, R over K divided by K. When I talk of D, this is the dividend per share. Dividend per share. E is the earnings per share. Earnings per share. R is a capitalization of the return on investment. Return on investment. K is the cost of capital. Cost of capital. Cost of capital, or the internal rate of what? The internal rate of return. This can be the capitalization rate. And talk of it as the capitalization rate. From the Financial Management, December 2021. Financial Management, December 2021. December 2021. Financial Management, December 2021. We do question number Do question number 1D. Question 1D. December 2021. Question 1D. December 2021, question 1D, you were given. Oh, this is using Godons. I don't want that. Your Godons mtafanya. I should be doing which one? Na ingine, not this one. I should be April 2024, question number 4B. April 2024, from financial management. April 2024, question 4B. April 2024, question number 4B. The following information has been extracted from the books of BD Limited for the year ended 31st December 2023. We've been given the earnings after tax. We have the total dividends and we have the number of ordinary shares outstanding. We have the cost of capital and we have the rate of return on investments. You are required the theoretical market value. Now, theoretical market value will be dividend per share plus the earning per share minus dividend per share, the return on investment over the cost of capital, divided by the cost of capital. So we need first to get the dividend per share. It will be given by total dividends divided by the number of what? Number of shares. Divided by the number of shares. So the total dividend here was of how much? We were given that is 2.2 million, which is 250,000. I divide by 500,000. So how much is it giving you as the dividend per share? We'll also get the earning per share, which should be the earnings after tax divided by the number of shares. So the earning after tax is that is 750,000. I divide by the number of shares, which is 500,000. So how much is it giving you? How much is it giving you the dividend per share? 4.5. What about the earning per share? The earnings per share. Yeah? 0.7.5. We know our R is the return on investment, which is at 12.5. Then we have the return on the cost of capital, which is K, 10%. So our intrinsic value or the theoretical value will be dividend per share plus 7.5, 4.5. This is 0.125 over 0.1 divided by 0.1. How much is it giving you? How much is it giving you? Inakupea ngapi? How much is it giving you? Is it giving you how much? It is giving you how much? What is the value? Mm-hmm. 32.82.5. 82.5. 82.5. 82.5. So that is the James Walters model. The James Walters model. James Walters model. We do also, the other one is super profit model. The super profit model. Super profit model. Super profit model. Super profit model. You see, super profits are return in excess. Super profits are return in excess of the normal profits. They are return in excess of the normal profits. Super profits, they are return in excess of the normal profits. Says the normal profits. So the return in excess of the normal profits. Now, for us to get the intrinsic value, we normally take the tangible assets. Tangible assets. We add the intangible assets. Intangible asset here is generally the goodwill. So the goodwill here, then you divide by the number of shares. Number of ordinary shares. Divide by the number of ordinary shares. Now, the intangible assets, which is the goodwill, is the one that is now determined using the super profit method, the goodwill. So here you take the super profits, you multiply by the number of years of purchase, number of years of purchase, divide by the number of years of purchase, number of years of purchase. That is how in this case we get the super profits. We do FM May 2019. Do from the financial management, May 2019. From financial management, May 2019. May 2019, question 2B, Roman 2. May 2019, question 2B, Roman 2. to be Roman 2. XYZ Limited has a tangible assets worth 48 million and a return of asset of 12%. Given the company expects to receive 10 million annually for the next 5 years. Given the company shares outstanding in ordinary shares, and we are required the theoretical value using the super profit model. So this is it. We know to get the theoretical value is the tangible assets. Assets. You are the intangible assets. Asset divided by the number of what? The number of ordinary shares. So first I get the super profits. Super profit will be given by the expected profit, which is 10 million. You minus the normal profit. Normal profit is just the return on assets, which is the return on investment. It should be 12% of how much? 48 million. How much is it giving you? 12% of 48 million is our the normal profit. How much is it giving you? In millions. So it is 5.7. Evo. So we can now get the intangible assets. We've said is the super profits. You multiply by the number of years of purchase, which they were 5 what? 5 years. So in this case, it will give you how much? It will give you how much? Yeah? Sure. 4 million point. Hivyo. We are reducing 10 million, sindio purity. So if you multiply by 5 is given you how much? 21.2 million. So our value will be the tangible asset 48 million. 21.2 million. I divide by the number of shares are 2 million. So how much is it giving you? How much is it giving you? How much is it giving you? How much? 20.6. That is per share. Another method, I have the price earning ratio. We have the price earning ratio method. Can have the price earning ratio method. Price earning ratio method. Say this method uses a price earning ratio. Price earning ratio method, and you say this method uses a price earning ratio. Price earning ratio to determine the value. Determine the value. Now, price earning ratio here is normally given by MPS over EPS. So with MPS now, this is what represents our value. So if you use this method, our value, which is now the MPS, should be the price earning ratio. You multiply by earnings per share. Multiply by earnings per share. Multiply by earnings per share. Last one is the earnings capitalization method. Earnings capitalization method. Earnings capitalization. So this is a method of valuation. This is a method of valuation. This is a method of valuation which uses the earnings to determine the value, uses the earnings to determine the value of ordinary shares. Earnings to determine the value of ordinary shares. This is the last earnings. G is the growth rate. KE, cost of ordinary shares. G is the growth rate. G is the growth rate. G is the growth rate. Growth rate. So that is on valuation of ordinary what? Valuation of ordinary shares. That is on valuation of ordinary shares. So we now get to valuation of preference shares. And now get to valuation of preference shares. Now get to valuation of preference shares. Of preference shares. Valuation of preference shares. Valuation of preference shares. Valuation of preference shares, and you say these are fixed return security. Saying these are fixed return security that earn a fixed rate of dividend. Fixed return security is a fixed return security that earn a fixed rate of dividend. Fixed return security that earn a fixed rate of what? Dividend. Now, to get the value of preference shares, generally the dividend per share, you divide by cost of preference what? Shares. So this is dividend share. KP, the cost of preference what? Preference shares. Here we know this is the intrinsic or theoretical value. Intrinsic or theoretical. Intrinsic or theoretical value. Intrinsic or theoretical value. Intrinsic or theoretical value. FOA paper, fundamentals of finance. Fundamentals of finance. FOF paper. From the fundamentals of finance, we do in the sitting off. From the fundamentals of finance, we do well, the paper is not here. Should be around August 2023. Let me just share that very quickly. So from that paper of fundamentals of finance, there is that one that I've shared. April 2023 question 5D. FOF. April 2023. Should be 5D. Check on the one that I've shared. April 2023 should be 5 votes. D. Being given that Blaze issued 15% preference shares to raise funds, we're given that the shares have a value of 100, and they are currently selling for 140 each. Minimum required rate of return 10%. You are required to determine current intrinsic value of the share. So intrinsic value of the share will be the dividend per share over KP. D is the rate. We have the preference dividend of 15% at VAR value. This will be 15. KP is the minimum required rate of return, which is 10%. So in this case, it will be 15, 0.1, 100 and what? That is the intrinsic value, which is the theoretical value. So Roman number 2 are devised based on whether to buy the share or sell the share. So should he buy the share or sell the share? Should he buy the share or sell? Now our market price is MPS here is 140. Theoretical value is 150. So is first we'll look at whether the shares are overvalued or undervalued. So the shares are overvalued or undervalued? The shares are what? Anastasia. Is the shares overvalued or undervalued? Now, the real value tunajua ukweli ni hii. Wanatuzia na 140. Si wanatuzia na pesa kidogo. That means he's undervalued, underpriced. And therefore, if he's underpriced, he can buy the what? Yeah, so say MPS is less than the theoretical value or intrinsic value. Intrinsic value, meaning that it is under what? Undervalued, and therefore, so buy the what? Buy the shares. Buy the shares. Now, valuation of bonds or debentures. We can talk about that. The last one now. Well, valuation of bonds or debentures. Valuation of bonds or debentures. Valuation of bonds, or what we call the debentures. Valuation on bonds or debentures. Valuation of bonds or debentures. Say, debentures are fixed return security. Debentures are fixed return security whose benefit, fixed return security whose benefit is interest. Just a fixed return security whose benefit is interest. Debentures a fixed return security whose benefit is interest. You see, there are two types of debentures. There are two types of debentures. Number one is irredeemable, and be debenture or bond. So irredeemable debentures. Irredeemable debentures. So these are debentures that do not have. We have irredeemable debentures. Irredeemable debentures, and you say these are debentures that do not have a defined maturity period. The debentures that do not have a defined maturity period. The debentures that do not have a defined maturity period. Debentures that do not have a defined maturity period. Now, to get the value of the irredeemable debenture, we'll take the interest, 1 minus the taxation, divided by the cost of what? Debenture. This is the intrinsic value. Intrinsic value. Interest. This is the interest per debenture. Per debenture. KD is the cost of debenture. Cost of debenture. The cost of debenture. Roman number 2. Roman 2 is redeemable. Redeemable debenture. Redeemable debenture. Redeemable debenture. Redeemable debenture. Redeemable debenture. You say these are debentures that do not have. These are debentures that do not have. These are debentures that do not have. These are debentures that do not have a defined maturity period. I mean, that have a defined maturity period, sorry. These are debentures that have a defined maturity period. These are debentures that have a defined maturity period. So to get the value of the redeemable debenture, it will be the present value of interest. You are the present value of maturity, value of maturity value. When we talk of maturity value, it is the vowel. The talk of maturity value is the value. Maturity value is the value. So from the FOA paper, now that we are on that paper, December 2023. Is it December 2023? No, should be December 2022, option 2B. December 2022, 2B. December 2022, question 2B. From the FOF, December 2022, question 2B. Julius, tunaenda mbio. Oh. December 2022, 2B. Umesema 2D ama 2B? Should be 2D. 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 So we've been given that Paulo Kalama is considering investing in a 5-year shillings 1,000 value bond bearing a coupon rate of 7%. The Paulo Kalama required rate of return is 8%. Bond is quoted at 950 in the bond market. Bond will be redeemed at value. Now, this is a redeemable bond. It will be redeemed at how many years? 5 years. So, meaning that for us to get the value, we get the present value of interest. It will be present value of interest. You add the present value of maturity. Present value of maturity value. Get the present value of the maturity value. So we begin with the present value of interest. Now the first thing we'll do is to get the interest, and this is always per debenture. So now what is the interest rate? We look at the interest rate was 7%, which is a coupon. So 7% of 1,000. The interest will be of how much? 70, right? So we can get the present value of interest. We know interest is paid per annually and is on equal amounts. So I use the equity, the time value of money, the annuity, present value interest factor of annuity. The required rate of return is 8% in year 5. So this will be 70. Go to the present value table. Present value table, 8% in year 5 on the second table. That is the annuity table. Is how much? $3.992. 3.9927. You multiply that, how much is it giving you? You multiply by that, how much is it giving you? Huh? 279.5 volt. Equal to 5. 489. Present value of the maturity value, it will just be the maturity value, which is the value. You multiply by present value interest factor, 8% in year 5. Maturity value was this 1,000 is the value. So you go to, now maturity is what we will pay when you redeem the bond. So is what is paid at maturity. You have to pay the interest plus the principal, which is the value. So you go to the first table. So this will be only in year 5. Therefore, it will be 0.6806. 806. So this will be 680.6. So what is the intrinsic value? What is the intrinsic value? What is the intrinsic value? 960.089. 960 0.089. 960.089. So the other thing is on Roman number 2. Revise on whether the bond is whether you should purchase the bond based on your computation. Now, intrinsic value is 960.089. The market value of the bond. What is the market value of the bond? You are told that in the bond is trading at how much? 950. So the thing is it overvalued or undervalued? Elijah? Undervalued. Therefore, since it is undervalued, it can do what? Purchase a bond. It is underpriced. Intrinsic value is less than the market value. I mean, is greater than market value of the bond. Therefore, purchase the bond. Purchase the bond. Therefore, purchase the bond. Purchase the bond. Can also do FOF April 2023. This is on question number 4C. April FOF April 2023. We do question number 4C. Modern Appliance has recently issued shillings 100 10% convertible bond. Bond can be converted into 20 ordinary shares at the end of the 5 years. Current market price of the shares of the Modern Appliance is 30 per share. Price is expected to grow at the rate of 10% per annum. Investors' required rate of return is 14%. At the current value of the bond. Now, this is the market value of a bond. And the market value of a bond is the value of the bond when it reflects the current market condition. So value of the bond when maturity value reflects current market condition. Hiyo ndo tunaitanga market value of a, andika hivyo. Market value of a bond is the value of a bond when maturity value, market value of a bond is the value of a bond when maturity value reflects the current market conditions. Maturity value reflects the current market conditions. Maturity value reflects the current market conditions. So this is it. To get the value of a bond, this is the current, call it the current value of a bond should be equal to the present value of interest. You add the present value of maturity value. So we begin with the present value of interest. First, we get the interest per bond. It was how much? Interest rate is 10. The value is 1,000. This is 10. Is it 10 or 100? 100. We get the present value of annuity, which will be annuity. Present value interest factor of annuity. The required rate of return is 14%. This was for how many years? It was to be converted in 5 years. So this will be 100. Multiply, we go to the annuity table. Annuity table, 14% in year 5. This is 3.444331. So this will be 343.31. That one should be now the present value of maturity value. Present value of maturity value. Now the first thing is to get the maturity value. So how? Now how do I get the maturity value? Is the value at which it will be redeemed. So at the end of the 5th year. So they can be converted into how many shares? Huh? One bond can be converted into 20 shares. Price of that bond ni ngapi? Or the price of a share? Sini saizi. So the question tutajiuliza in 5 years, what will be the price? So how do I get the price in 5 years? Unione kama mnakumbuka time value of money. How do you get the price in 5? Kama saizi tumeambiwa price is how much? 30. Si ndio? Na tumeambiwa the price will grow at how many, what percent? 10. So in 5 years, how do I get the price in 5 years? Wait, how do you get future value? Present value 1 plus R power what? N. Hiyo mnakumbuka? Sasa hivi ndo nitafanya. So my maturity value will be equals to the number of shares here, they are how much? Will be the 20 shares. I multiply by the 30, the current, 1 plus the growth rate, which is 0.1. Then I do what? Hiyo ndo itanipea maturity value. It can be converted into 20 shares. Ni sawa. Now each share is trading at how much? 30 now. So in 5 years, the price itakuwa ngapi? That you multiply by 1.2 what? 1.1. In 10%, so should be 1.1. So ni 0 plus 0.1. Hivyo. So how much is it giving you? Yeah? 9? 3? So hiyo ndo maturity value. We know the present value of maturity value will be the maturity value, present value interest factor. This is 14% in here. So I will now take the 966.306 Multiply by how much? 14% in your 5 from the first table is how much? 0.5194. Multiply. Kupea ngapi? Ah, 501,899. So our current value will be how much? The value? Present value of interest 343.31, 501.899. Inakupea ngapi? How much is it giving you? How much? 845.209 equal to 45.209. Financial management paper. Now the last one. Financial management paper. Financial management paper. April 2023. Section 2C. Financial management paper. April 2023. 2C. April 2023. 2C. Now, Umi Limited is contemplating to issue 8% bond redeemable at shillings 100 value in the 3 years time. Alternatively, each bond may be converted on the date into 30 ordinary shares of the company. Current market price of the bond of the per share is 3.3 and is expected to grow at the rate of 5% per annum. Cost of the debt is 6%. Acquire the market value of the what? Market value of the bond. So how do I get the market value of the bond? Value of the bond to be the present value of interest. I add the present value of maturity value. So we begin with the present value of interest. Present value of interest. Now, present value of interest here will be first we get the interest. Yangapi? What is the interest rate? 8% of the value, 100. That will be 8. Present value of interest will be of the annuity. Annuity, present value interest factor of annuity. This will be how much? Interest rate is, the cost is 6% in how many years? 3, 8. Go to the annuity table, 6% in period 3. Annuity table 6% in year 3. Two point what? 6730. So if you multiply, how much is it giving you? You multiply na kupea ngapi? $21.424. Huh? 434. 384. That way. We get the present value of what? Maturity value. First is to get the maturity value. Now, how many shares? It can be converted into how many shares? That is, no. I should multiply by the price at the end of year 3. We know right now it is 3.3. 1 plus the growth rate. It is growing at how much? Price in a grow na ngapi? 5% hivyo power 3. No. What will be the maturity value? What will be the maturity value? Huh? 114. So present value of maturity value will be the maturity value. Present value interest factor, 6% in here. So it will be 114.6. Go to the table. That is now the first table. 6% in year 3. It is 0.8396. Kupea ngapi? Multiply that, how much is it giving you? 20? 96 point. So get the value. Value will be 21.384. 96.22. Kupea ngapi? $1.606. That is the value of the bond, the market value of the bond. Roman number 2. But who is the floor value of the bond? Floor value of the bond. Floor value of the bond. Floor value of the bond. Now, floor value of the bond is value of the bond when maturity value is equals to the VAR value. That's how. It is the value of the bond when now the maturity value equals to what? VAR value. Is that okay? Value of the bond when maturity value equals to the VAR value. Value of the bond when maturity value equals to the VAR value. So present value of interest here, haitabadilika. We love it here. It was 8 you multiply by 2.6730, which was 21.3. Present value of maturity. Maturity is now the VAR value here. And therefore, the VAR value was 100. I will just multiply by 0.8396. This is 83.96. What will be the floor value of the bond? What will be the floor value of the bond? One on 5, 3, 4, 4. Roman number 3, the last one. The one we look for the conversion premium per what? Per share. So conversion premium. Now to get the conversion premium should be given by the market value of the bond minus the current market value. So market value of the bond tumepata ngapi? Yes, 117.606. Currently, the shares, they can be converted to how much? They were 30, and they are currently trading at 3.3. You know, it had to pay the current market value. So if you minus from there, what will be the conversion premium? Conversion premium? 18.606. We want the per share. So per share, you just get the total conversion premium divided by the number of shares they want, 30. How much is it giving you? 3.6, 0.6202. And we are done with that. And also, it marks the end of the topic, valuation of securities. So in that, you can do the following as assignment. That do the following as assignment. From financial management, do December 2021, question 1D. Financial management, December 2021, 1D. December 2021, 1D. You'll also do May 2018, May 2018, question 1C, 1B, 1B. November 2018, question 5B. November 2018, 5B. May 2017, question 2A and C. May 2017, 2A and C. 2A and C. 2A and C. Then November 2015, question 1C. November 2016, 1C. Introduction to Finance and Investment, the IF5 paper. Due August 2024. Introduction to Finance and Investment, August 2024, question 1C. August 2024, 1C. April 2024, question 3D. 4C. Question 4C. December 2023, question 3C. December 2023, question 3C. April 2023, question 2C. April 2023, question 2C. Yeah, that one. Just do those ones. Or I have the introduction to finance. FOF from the fundamentals of what? Fundamentals of finance paper. Fundamentals of finance paper. Do fundamentals of finance. You do. April 2024, question 26 to 27. April 2024, 26 to 27. And 29. 26 to 29, just say that. April 2024, 26 to 29. And you also do August 2022, question number 4C. August 2022, question 4C. Do those ones as assignment. We will meet and now do another topic, the cost of capital. So we do cost of capital in our next class.